Hello, folks. Welcome to the Weekend Investing Daily Bite of Tuesday, 27th of May, and a very, very volatile day today. Uh, while the subject for today's discussion is around trends, and no trends last forever, but even during the day, no short-term trend was lasting more than an hour or so. So we had a nice move down in the morning, then a fantastic move up in the afternoon, in the mid morning, and then by afternoon we were down again, and then there was another sort of attempt higher. So it was almost like expiry day moves. Tuesday is likely to become the expiry for NSE, and maybe some practice was going on for that by algorithm running firms. Just that's and essentially nobody in the very short term would be making money with this kind of volatility. So whenever there is substantial volatility, it does mean that the market is trying to put in some sort of a bottom or a top. That usually is the case. So net net, we haven't really lost much ground, but we are finding it very difficult to cross 25,000. That sort of is the current situation. Do read the disclaimer fully and do subscribe to the channel if you haven't so far. Let's see where the market is headed. So as you can see in the chart, we are very much in that zone of 24,500 to 25,100, and we have been playing this zone for almost 12 sessions. So beyond this move up, we have not really gone anywhere. So it has been choppy plus minus here itself, which is not such a bad deal, given that we had this kind of a run, and now it is the markets is sort of arcing and maturing into a flattish zone. So consolidation is happening before the next big trigger, whatever it will be, comes around. Minus 0.7 on Nifty. Nifty Junior didn't fall much, so perhaps there may be more FII sales numbers in Nifty stocks that caused that. Nifty Junior was reasonably flat, minus 0.27%. Mid caps also very flattish, 0.2% actually in the green. Small caps 0.11%, even more flattish, absolutely flat there. And Bank Nifty down 0.39%. So it seems like some larger funds were trying to get out, especially in the morning. There, on the geopolitical front, US and Russia are again at loggerheads. There is no other news that could have sort of triggered this, but it is extremely choppy. As I mentioned, last 11 or 12 sessions is within this choppy zone. Gold also down 0.98%. So gold is also not able to break out of this channel right here. Perhaps it will come and take a support again at near 9400 levels. Here you can see what was happening. So Nifty 500 advanced decline ratio 231 to 268. So it ended reasonably equally, but you can see that the declines initially there was a declining phase. Declines became very high, advances were very low, and then you know by noon declines had reduced and advances had risen, and then there was another third leg, and then there was another fourth leg. So it was complete mayhem for very short term traders, I would believe. In the Nifty heat map, you can see Geofinance taking lead at 3.4%. So there is breaking news that Geofinance is tying up with BlackRock for a mutual fund. That's perking up the news. IndusInd Bank of all banks was up today. So ever since the news recently has broken out about the misdoings in IndusInd Bank, it has been going up. So everything was discounted when the first news came a month or two back, and that has been the bottom for that stock. HDFC Bank, ICICI Bank, Axis Bank, Kotak, all down. IT stocks down, Reliance down, cement and steel down, autos down, FMCG down, and some flattishness in pharma and infrastructure stocks. In the Nifty Next 50 space, also you can see some give up in Indigo, promoters selling out some stake. So large chunks of promoter deals are happening. So it is not that liquidity is of any concern in the market. So many deals are happening which are of large quantum in nature. So there is domestic as well as foreign fund flow in reasonably abundance, and that's why these deals are possibly happening. VBL, HAL TVS Motors, Siemens had some marginal gains, and you had Pidilite, Naukri, Indigo, BPCL, Divi's Lab, Bajaj Holding, and Britannia losing some ground. In the sectoral trends, you can see India defense is again up. So defense was once again 1.06% for the day. It's just going one way. Defense is just not stopping. Even on day where most of the market was down, defense stocks are up. PSU banks also marginally up, real estate marginally up, MNC pharma stocks also marginally up, but everything else was down, and FMCG was the worst hit with minus 0.88%. So FMCG also has become like a rudderless boat, 2 days up and 2 days down on that front. Commodities down, IT down, autos also very, very fickle. Consumption stocks down, everything was down on that front. Um, Defense index, another new high. Mishra Dhatu, GRSE, Scient, BDL, Astra Microwave leading the defense stocks. So the demand continues to come in. And from a March first week bottom of 5,000, we are at 8,600. That's the kind of jump defense index has seen. In FMCG stocks, we are in a flattish territory since mid-April, down 0.88%. ITC, United Spirits, Godrej Consumer, United Breweries, and Britannia losing some ground there. So let's talk about this thesis that no trend lasts forever. So be very, very careful. So for 4 decades, we've seen, for instance, the 20-year Treasury bond index go up. And bonds were the way of portfolio construction. 60/40 became the go-to bond, equity bond portfolio structure. Any advisor that you would go to globally would say, put 16 in equity, 40 in bonds, and you're good to go. Because this had been happening for 40 years, that yields have been coming down and bonds have been going up. So it became like a de facto 40%, asset allocation to bonds became uh, a no-brainer. But since 2020, yields are going up and bond prices obviously are going down. So the TLT, which is the ETF traded in the US, has actually not made any money for the last 12 years now. So after this fall here, you can see that we are exactly where we were in 2013. And if you are allocated 40% of your portfolio to an asset class where you've not made any money for 13 years, imagine the underperformance in your portfolio that you're going to get. But it will take a long time for people to realize that the trend is changing. Perhaps we should allocate, instead of bonds, 40, maybe 20 to bonds, 20 to gold or some other asset class. Recency bias, which sounds like extremely recent events, can also drag for a long period of time. It will take years and years for that mindset to change. And if it has to change, that 60/40 equity bond portfolio is no longer working. Although for the last 12 years now, if we were to see in hindsight from today, this has not worked. But still, a significant amount of global investment funds are into bonds. And gradually, as performance bleeds, money will likely come out of that also. And as money comes out of bonds, bond yields can even go up further. So it is like a chicken egg problem that is continuing now. A lot of money coming into the bonds can save this, but if that happens, it means a lot of money printing would have happened, QE would have happened, or perhaps some flow of huge money out of equity would happen to go into bonds, and that doesn't seem like the case happening right now. So this is a gigantic, titanic sort of I would say a nuclear bomb that is, just sitting on top of the market. That if this gets pricked, where do things go? I mean, if there is a gush of money out of bonds into equity, of course, equity will go up because it will get the liquidity. But this bond crisis, if money starts to get out of bonds hand over fist, then yields will go out of control, and that is going to hurt the overall economy in a very bad way. So the key takeaway here is that no trend lasts forever. So you have to change with the trend. If you have had a great success for 20 years following some trends, it does not mean that the next 20 years are going to be like that. As people found out in Japan, as people found out, let's say, in trends of certain sectors, for instance, public sectors, banks were dead for almost 10 years, but then they performed miraculously well. uh, Stocks like good stocks like perhaps Hindustan Levers, Reliance, ITC have remained trendless for long periods of time, and then they went into a very strong trend, and then they went into a very strong downtrend as well. So trends are there, that is not going to last. Gold has been out of trend from 2011 to 2017-18, but then it trended very nicely so far. We don't know whether it is going to trend further or not in the same way. So this recent trends tend to give us this recency bias, and we tend to go along, and that creates complacency. So most stable asset classes can go through painfully long lasting drawdowns, and those trends can change. The other key takeaway is that the world is rapidly evolving. So a lot of macro regimes are shifting. Technology is creating its own ways of how the world is evolving. Inflation is rising, changing interest rate cycle. Just like I mentioned, 40 years of trend has changed there. Geopolitical instability is coming in big with multipolar world. What worked in the past may no longer work in the future. That even for Indian market, I mean, just to blindly assume that what has happened in the last 30 years, we have the demographics to do it in the next 30 years, but there are so many conditions that need to come together for that to happen. We were the same country 30 years back also, but we had the episode of 1991 where we had to pledge our gold. So things can change over time, and you can't really have a blind tangential line extrapolated to say that I got this in the last 5 years or 10 years, and hence I will get this in the next 10 years. So you need to stay very nimble. You need to stay curious. You need to uh, not follow blindly any path that you're taking, and you have to continuously reevaluate your decisions, assumptions, and adapt to the change. So agility becomes very, very important, much more than dogma, which is like I'm just like ostrich with the head in the sand, and I don't care about the rest of the world, and this has to happen. That kind of an approach can really burn you very badly. And the last thing is, like people are saying XYZ asset is very safe, for instance. So the US treasuries, for instance, were the gold standard of safety. Like anybody who is having any concern about uh, any risk in the system, any institution, any central bank would rush towards US treasuries. But now most people don't want to buy US treasuries because uh, you know they have dug themselves that kind of a hole where it is now being doubted that US can fulfill the promise of the treasury. That is why the credit rating has come off, and of course 11 years zero returns on treasuries. So safety without returns is not protection, it is stagnation. So safe, the word safe has become very, very relative because you are comparing all other risk assets versus this risk free asset, and this risk free asset itself has become risky now. So where do you benchmark risky assets, uh, if your benchmark itself has moved? Also, past success can be a setup for future surprises. So, long periods of one sided performance can lull investors into overconfidence. This happens all the time, whether it is a short term trend, whether it is a longer term trend. Um, Somebody making good money in some stock or in some sector or in some market, and then this overconfidence comes that this did very well for me so far, and hence it's going to do very well for me in the future also. And the biggest risks will come when everyone agrees on the same playbook. So look out for over agreement on the same approach. So whether it is stocks, whether it is bonds, whether it is particular stocks, whether it's particular sectors, And whenever you will find that everybody is agreeing on the same playbook, those are the biggest risks. So these are some of the things that you need to keep in mind to make sure that you are able to adapt to changing trends in the marketplace. And the whole idea is that, this, like for instance, this current fall that we've had since September, October, and we are almost trying to make up for it. uh, is it a larger fall? Is it a fall in a larger long-term bull market, or have we sort of made a peak and now we'll probably make a lower peak or a double top and then fall off? So all this actually is going to influence how you're going to decide on how you're going to approach these stocks, unless you have a very structured way of approaching your investment, which of course I will recommend. So that's all for this video. Thank you so much for watching. Do like and share these videos if you like the content, and do subscribe to the channel. Thanks. Bye.